Welcome back to Primary Source China Investment. This week we're on show P7, and we're talking about China equity, where to turn. For 2024, the CSI 300 returned a little bit over 14%, and a lot of that was on the back of stimulus that was announced in September. But since then, it's given a lot of it back, and year to date, just a few trading days into the new year, the CSI 300 is already down 5%. And global allocators are faced with a number of headwinds, and we've talked about them a lot, right, Peng Guo, right? Low consumer
Yeah.
confidence,
Mm.
high youth unemployment, declining interest rates, US sanctions. We could go on and on. But if you are allocating to China or you're a mainland investor, how do you navigate? So this week, we have three themes that we think will carry through 2025. And the first is dividends. Most Western investors may think of the China market A shares as a growth market, but we've talked about it before. There's a lot of value potential. Some of those names are big SOE type companies in industries that are largely protected, shipping industries, commodity industries, power industries. Here are some of those types of names that offer great dividend return and lower volatility. Oh, well, what do you think about the dividend strategy for 2025, given that fixed income rates have come down a lot also?
Yeah, dividend definitely is a traditional strategy, especially in the downsides, or at least the market is not in the uptrend. Definitely should consider the dividend strategy. And that is overall, people still can say large good dividend companies performance better than others.
The consumer, the investor in China also is facing this declining interest rate environment. So you're really looking at maybe very low single digit returns from fixed income products, whereas you can maybe look at 4, 5, 6% on a dividend yield with some of these income producing companies. So our second theme is China domestic. There's a high correlation with high dividends and large Chinese companies that are domestic in nature. Think big banks, power, energy, chemical. These companies also enjoy a large moat in that it's difficult for foreign firms to compete. So what we're saying is if it's good for the Chinese consumer or if it's good for China, it's probably good for your portfolio for this period of time. What are your thoughts there, Peng Guo?
I think you're right. That is also is a kind of the traditional strategy allocate those companies because they have the better market share or in the monopoly place in the market. As long as in a bad situation or a recession period, those big companies get better risk-adjusted performance compared to other small companies.
Yeah, it's a little bit of defense, but also these large SOEs do enjoy some, favored status domestically. They're going to get the lowest rates on loans. They're going to get the first contracts for big infrastructure. These are the kind of things that investors need to look at instead of looking at the highest flying names. And that's our third point here. Look at lower tech, not high tech. And what we mean by lower tech is avoid the highest flying names. In the US, those names are traded under KWEB, and that is the largest ETF owned by US investors related to China. And sure, people know it, billions of dollars are in it, but it is currently trading at 70% off its all-time highs. As we like to say, that's a lot of wood to chop. And these names are also ground zero for potential sanctions implemented by US lawmakers, a topic that we've talked about a lot. So what do we mean by lower tech? Well, it's the backbone for the internet for China. And this checks a lot of boxes. We're looking at China Telecom, China Mobile, China Unicom. These are the types of companies that enjoy a very large moat, very little competition, a lot of Beijing support, and you're looking at a tech economy in China that is dependent on these companies.
That's right. So yeah, and just want to add one more point is you have to clearly understand the cycle of the each sector because they really have the different performance in the same period. That is the key. For the market overall, like probably we already see Goldman Sachs, they predicted the sales of 300 companies profit will increase the 10% to 12% in the 2025. But in my opinion, in 2025, increase the company's profit is kind of the topic in the market. How to do that? Most likely increase the inflation. So China really needed the inflation rather than deflation. So as long as people already pay attention to the price competition, so the dark side of this price competition is already showed in everywhere in all the industry. So most likely, a government will firstly take the tax. So they through the tax collect the money and subsidiaries from small companies, lower performance companies. So they will force them to increase the cost, and then they will squeeze out those not see the bad companies, it's really not a very well companies from the market. And also after the government collect the tax, they use some kind of the subsidies to the consumers. So it's not like the United States, okay, give you the money directly. So that's
Yeah.
definitely not working. They probably give like the some kind of the certificate, so people can use that to purchase the consumers, especially for the durable long-term consumer product.
Yeah, white
For
goods,
the
home products,
for the rich
appliances.
people, they don't care. Okay, I already have that. I don't care.
Yeah.
But this is more like the more accurate subsidize the people and pull out the increase the demand in the market. So I think the rest of the companies will get a better growth and a better performance in 2025.
Yeah, it looks like that's already underway
Oh, yes. Mm.
in a lot of the small mobility types of products, scooters or little motorcycles or mopeds or dianpingche, whatever you want to call them. It's vicious competition. You're seeing that in product after product after product, and the competition is fierce. We've talked about this a lot, and
Yeah,
that's the
that's really need
reality
to
for
break the price competition. It's a
yeah.
bad cycle.
Yeah,
Nobody really
it
like it.
race to the bottom in so many industries.
Sure.
I did want to mention one other point here. Foreigners are not going to save the China stock market. I think we've discussed in the past that maybe foreign investment is a nice thing to have. It's a positive sort of green shoot argument, but foreigners own about 3.1 trillion renminbi, 425 billion US dollar equivalent of onshore shares. That's 3% of the market. So there's just no way you're going to get the foreigners to move the market. The only thing that's going to move the market in China is the retail investor. And a lot of this trickle down is exactly what we're talking about. You need to have interest rates low, so investors are looking at where else can I get a return on their money, and they have to look at the stock market as a way to increase their net worth.
Yeah, I totally agree with that. So nobody should save the market. Government really need to monitor the market and punish the unfair or manipulation activities. So we came to the market, we do the fair investment. Obviously, the volatilities it really depends on the should sooner or later back to the company's performance.
So for 2025, we're calling for some strategic defense when allocating to Chinese equities. So we're going to leave it there with show P7. Thanks for tuning in, and we'll see you next week.
Thank you.